You are listening to Keystone's Stock Top Show, episode 300. It's great to chat with you again this week. I will kick off with part 2 of my segment on the picks and shovels investing approach, focusing on 5 steps to identify picks and shovels stocks. Brett answers a question on everybody's mind: is steel a steal? He explores the action in steel and aluminum stocks, including Cleveland-Cliffs, symbol CLF on the New York Stock Exchange, Century Aluminum, CENX on the NASDAQ, which jumped over 20%, and on the flip side, Algoma Steel, ASTL, on the TSX was dropped after U.S. President Donald Trump again increased tariffs on steel and aluminum to 50%. In our Your Stock Our Take segment, Brennan revisits PyroGenesis Canada Inc., symbol PYR on the TSX, which designs, develops, manufactures, and commercializes plasma processes and systems in Canada. Last but not least, the birthday boy, Aaron Dunn, provides a synopsis on his small cap gold stock playbook: 7 timeless rules for picking winners. All right, let's get to the show. I'm going to welcome my co-host, Mr. Aaron Dunn, the Killer Bees, Brett and Brennan. And we're going to start by saying happy birthday, Mr. Dunn. How are you doing?
Yeah, I'm good.
Did you have a good weekend?
I did. Yes, I did. Spent the weekend with the family, had a 50th birthday party. And
what? We were going to say it was your 39th. What are you talking about?
I was trying that, and people were just like, well, you look like you had a really rough life then if you're only 39.
True.
And I decided that wasn't the best direction to go, and just accept that I am in fact 50 years old. And
it is crazy.
Nothing wrong with
joining
that.
the club. Yeah. We wish you a wholehearted happy birthday.
Appreciate that. Thank you.
Good. Hopefully you had some good times with the family. Is there anything we want to chat about that's going on in the markets right now? Or do we just want to get into, picks and shovels? Is that
we can get to the poll.
Forgot about the poll. Come on.
You forgot about the poll.
The poll. Yeah. The Bank of Canada interest rates, right? We're talking about that.
Yeah.
Before the poll is what I meant. Yeah.
Before the poll. Yeah. So the Bank of Canada interest, they actually have their next decision a couple of days after recording. So if you're watching this, the first day after the podcast is released, the next day they'll actually have their next interest rate decision. So the current rate is at 2.75%. The question was, where do you think the rate will be by the end of 2025? 13% of our viewers said higher than the current rate of 2.75. 40%, the bulk, said will remain flat at 2.75. 33% said between 2.25 and 2.5. And then 15% said lower than 2.25. And frankly, I'm surprised we even got a few votes for higher than 2.75. But really the theory behind that is inflation is going to start to outweigh any other factor in the market. We're seeing weakening in the Canadian labor market slowly. It's not devastating by any means. Consumer spending is down, stuff like that. We did see the GDP read a bit better because our exports were higher. But the two opposing forces, either weak macroeconomics or high inflation. And that's what the article that I wrote is getting released on this week is all that. And it's interesting because the banks aren't even sure themselves. You do see a discrepancy between the banks and professional forecasters, which that is their job to do, is look at these macroeconomic forces. And there's not a clear consensus at this time.
Yeah, and I guess the question would be, if there is an increase due to some raising of tariffs, is it transitory? Is it a temporary increase in the rate of consumer prices, essentially? Or is it something that sticks long term? If it's transitory, then you probably, given the weakness in the Canadian economy, have lower rates. And that's what the bank believes.
Mm-hmm. Yeah, I think I ended up voting between 2.25% and 2.5%. And I was talking with Brett last week that, again, the GDP results for Canada came in, I think it was 2.2% growth, which was a surprise to the upside from my understanding. But again, with these tariffs being in place, we're seeing, a lot of, people front loading inventory, getting their exports or imports from Canada ASAP. So, I think that's generally what we're seeing with the GDP numbers. But again, we'll see what happens with the Canadian economy going forward here.
Yeah, I think I read that they were forecasting 2 rate decreases forecasted by the end of the year, was what the Bank of Canada said. And you'd think that would be the direction that they go in, of course, because I mean the economic picture appears to be heading in the direction of lower growth. So you'd want to stimulate. Now, if we get inflation from the tariff and the trade war situation, I would think that that's not something that the Bank of Canada would raise rates to fight, because that's not the type of inflation that their rates are going to affect. That said, I cannot predict if the Bank of Canada is going to see it like that. So
I agree with that, though.
You know, it's but I mean, I would think I voted it. They're going to be lower. Probably they go down 2 more times before the end of the year.
All right. Well, we've done the poll. Let's get into more picks and shovels, because we just can't get enough picks and shovels on this show. Apparently, I've stretched it into 2 weeks, so I'm going to get into
a segment could be created out of that. Picks and shovels, just all on picks and shovel stocks.
An entire investing wing could be made into picks and shovels. All right. Okay, so this is part 2 of my segment on picks and shovel stocks. I'm going to look at 5 steps to identify picks and shovels stocks. So the picks and shovels approach to investing involves buying companies, for those that aren't aware, that provide the tools, services, and technologies needed to support a larger industry, rather than investing directly in the major products or services businesses. Now, I'm going to again focus today on how to find picks and shovels approach. I got 5 steps that you can use today. Step 1, we're going to start by just identifying the trend. So what you got to do when you identify that trend is make sure the trend is economically significant and reasonably sustainable. For example, the pet rock was a popular trend in the 70s. Aaron still has one. It was literally a rock marketed as a pet. While its founder, Gary Dahl, got rich off the trend, it really was not large enough nor sustainable enough for our picks and shovels purposes today. As far as trend that was large enough, we can recall from segment 1 on this, Samuel Brennan and the California gold rush. Gold fever was a national phenomenon in the US and into Canada, attracting people from around the world to dream of fortunes in California. While rare, it was a trend where big fortunes were made. If there isn't enough money to be made in a trend or the golden carrot, then there won't be that much demand for supplies to keep that trend going. So the type of trends that we are looking at would include the internet, it's fairly large, AI, cybersecurity, electrification, blockchain, gold, and gold as a store of value. I think cybersecurity is so big, I put it twice on there, as you can see. Number 2 would be find the market leaders. Step number 2. Once you have found a significant market moving trend, you want to identify the market leaders in that segment. Take a look at investing websites such as TradingView. You can screen and search the trend itself, or look into the subsectors to identify the largest players. For some trends, the players are well known. In the AI space, for example, most people can identify Microsoft and Alphabet. In other sectors, such as gold service stocks or cybersecurity, it may be less obvious. Now, number 3, or step 3, would be discover which products or services are essential to those businesses, essential to the market leaders. After identifying market leaders, focus on the products that they sell. Determine what is essential to the product or service being sold, and is there something the market-leading companies would be not able to function without. An example for Microsoft and Alphabet, AI data servers and high-end chips or GPUs would be essential for them. For gold-producing companies that are trying to grow, they can't live without the drillers. Now, step number 4 here would be to research the companies that make those essential products or services. Once you discover the essential products or services the market leaders in the trends cannot live without, you got to find out who is supplying the essential components or services. For AI, one of the key components, again, like we said, are GPUs, or graphic processing units, which are powerful chips that accelerate graphics rendering and processing. If all the major competitors share the same supplier or suppliers of an essential component, you know that you have found a well-protected supplier. Another example here, if you foresee a boom in gold demand, drillers are essential to increasing existing and finding new deposits for these companies. Final step would be step number 5, screen your picks and shovel stocks for profitable growth. After identifying a group of essential components or service providers, it is critical to find the most profitable growth companies with strong financial metrics, including profitability, a good balance sheet, and strong margins relative to its peers. It is not good enough to just identify a supplier, for example, to a market leader. They have to be doing it profitably, or the investment makes little sense. I will finish this by saying in my article on picks and shovels investing on our website, www.keystocks.com, I identified an example stock that possesses a solid balance sheet growth and peer leading margins to serve as an excellent example there. And we talked about that company last week. All right, that's going to end my picks and shovels run, but I think we covered that to the largest extent that we could.
And there's a form in that article, correct, where they can get our most recent update report on that
company Geodrill, which is a great example of a company that's servicing. You see a boom in the price of gold. You want our latest update on that company. We do not provide those often. Our clients pay for those, but this is an update that we have there to give you a sample of our research. We have another company in research as well that we've just identified that is in that segment that trades at about 5 times forward earnings when we identified it. And, it continues to grow this year, and a company that we recommend right now to clients.
I mean, it's just good to have these different perspectives on how to approach investing in a certain segment, right? I mean, most people think, commodities, for example, well, you buy a miner, right? Or maybe a gold ETF, but there's just other ways to also approach it. And if you want to identify all the best opportunities, it's valuable to be able to look at it from those different viewpoints, right?
Picks for sure. And Aaron's segment's going to talk about producers, right?
Mm-hmm.
At the tail end of the show. So we're going to bookend it with a little bit more on gold. Now, Brett is going to talk about something that is on everybody's mind. Unless you guys, again, did I cut you off? Do you want more? Do you picks and shovels, Brennan? Do you got any picks and shovels info?
Brett can go, or no, I don't. But
you got nothing.
We can go on.
All right. It's what's on everybody's mind. Is steel a steal?
You love that one, don't you?
I've been saying that for years. Yeah.
Yeah. So as we know, Trump has just been constantly shifting tariff levels forward and back. You have the Trump always chickens out the taco, which the reporter brought up to him. And so, of course, now this last week on Friday after market close, we had another tariff announcement, and this time it is increasing the tariffs on steel and aluminum to 50%. Prior in March, he had it set at 25%. From the previous 0%. And this new tariff, the 50%, it will be effective June 4th, assuming nothing changes. I always have to, whenever I'm doing these segments now, I have to say, assuming nothing changes, because it always seems to. And I will remind our audience as well that in Trump's first term, he actually did apply tariffs on steel and aluminum, which lasted about a year. So it might not be, we might not have them for 5 years. We could have them a year, or they could be gone by the end of the week. We will just have to wait and see, or they could last for years and years to come. So now on to the market reaction. On Monday, as where we are recording this, U.S. hot rolled coil steel futures had jumped over 15%, and aluminum Midwest U.S. premium is up 41%. I will note as well there was a month rollover for the futures, which does impact the price, but the majority of this change will just be purely due to tariffs. So really big, effectively day-over-day increases of price of both the commodities or commodity products due to the tariffs. So, and then we can see the same reaction in the stock market as well. Cleveland-Cliffs, CLF on the New York Stock Exchange rose over 20% on Monday. I think before market, it was actually up 35%. So massive increase overnight. But that is actually still down 20% over the past month. And it is one of the biggest winners actually on this policy shift. As the stock market reacts, it was one of the biggest increases, if not the biggest increase. Probably depends on the time of day you have looked and where it actually closes at. Another big mover, Century Aluminum Company, CNX on the NASDAQ, up 18% on the day, and it's up about 6% on the month. On the other hand, if we look on the other side of the border, really more than anything, we see the negative movement. Algoma Steel on the TSX, and they as well trade on the New York Stock Exchange. A Canadian producer is down nearly 7% on the day, but it is as well down 15% on the month. Historically, 60% of Algoma's production was US bound, but under the current pricing and tariffs, it would just be difficult to see Algoma being competitive in the market. So likely that's going to drop to very low amounts in the coming months, assuming nothing changes. Further, as other producers aren't shipping into the US, as the entire market will react to not just Canadian, but any other participant that was shipping into the US, steel price might get either diverted into Canada, or within the Canadian market, it stays within Canada for a Canadian producer. So you'll see steel prices actually decline, as well as aluminum prices within Canada, putting further pressure on Canadian producers. So we'll see how that ends up. So does this policy of protectionism on US steel and aluminum make US steel producers an appealing investment in steel and aluminum producers? As the price of steel and aluminum rises, producers benefit. That's pretty straightforward to see. If prices do continue to rise, however, you will end up getting non-US supply coming back into the market, even with tariffs, if you see a massive regional price discrepancy, as there will be substantially different prices between the American prices and effectively everywhere else in the world, a regional price discrepancy. And likely if the tariffs last, countries will actually have retaliatory tariffs against the US and steel and aluminum industry, making US products actually less competitive on the global stage. So we'll see how that dynamic works out, both external to the US and internal to the US. So the US is a net importer of steel and aluminum, so they import more than they export. US net imports are 13% of consumption for steel and 47% for aluminum. So aluminum is much more dependent on non-US production. In 2018, Trump's first term, tariffs actually had only a 10% tariff on aluminum versus 25% on steel. So you can see even then, pulling back a bit more on aluminum compared to steel. So if anywhere I could see pullbacks on aluminum occurring before steel, or negotiating something like that, as that is a more critical aspect for the US economy to actually import steel at this time, because they just don't have the production level and they have higher demand in respect to the production level. So as we've seen before with tariffs in general, policy reversal will now be really a massive risk for companies that have seen a jump in price. This is Cleveland-Cliffs, for example. The company has not been profitable in Q1. The company had revenue of $4.6 billion and adjusted EBITDA loss of $174 million, which that would include the first 25% tariff for the 1 month, so March effectively, and it still wasn't profitable during that quarter. But most of the quarter wasn't really, it had no tariffs, but there was an increased price during steel during the quarter, so there was actually a positive impact, and they still weren't profitable. The point here being, while tariffs may be beneficial to the company, it does not necessarily create this massive gold rush moment, at least at this time. Just a better environment. It is no different really for the US producers compared to other periods of hiding prices. Like during COVID, you saw massive price increase then. I think it was about twice the price it is currently now, even after the tariff price changes. And they did have what I would call a gold rush for steel at the time, or steel rush if you want to. The company as well does have a significant debt level, which I will just highlight just as a general. So periods of weakness are especially harsh due to the interest rate burden. So with these fluctuating steel prices, if they are actually lowering their capex for the year, but let's say tariffs last year, they start to ramp up their capex. Just using that as an example, because then if you have the tariff removals, that can get them into trouble with the debt level. You always want to look at the company as well as just the industry macro, and that's what I want to get to the point with this. As well, the other point, which is the point which I really chose out Cleveland-Cliffs, is because the company actually did acquire Stelco, a Canadian-based producer, as a publicly traded one as well, just last year. So tariffs have caused the company subsidiary Stelco to actually focus 100% of its Canadian production to 100% Canadian sales. So you can see there on the map, they previously had about 30% going into the US. And that's what I mean. Canadian manufacturers of steel and aluminum products are probably going to keep them in Canada now, which will drive prices down here while the US prices actually increase. You're going to see this regional dynamic, which is actually going to be quite interesting to see how it plays out. And it's just going to overall increase the competition within Canada. As well, I will mention, though, that is a bit of a drawback for Cleveland-Cliffs. So it's not even just as black and white, even for an American company. The one that really on the first day of the stock market saw as the biggest benefit. They were up 20% at time of recording. It does even have a bit of gray for them because they're obviously going to have a bit of a pullback on their Canadian side due to this. And something they just acquired last year, which obviously not great timing for them on that. And I just want to simply to wrap this up, I'll just simply state, do not invest in a company due to a policy. Invest in a company that can be great no matter the environment. As I was showing, Cleveland Cliffs, it is losing money right now. Tariff environment might make it better. It probably will for the company as it is primarily a US producer. But that does not make it a great company. It does not make it a great investment over 5-10 years like you really want to be. It could be a trade, but we are not traders. We are investors. We're looking at the long term, and a policy does not make an investment, especially something which we have seen even in his last term, lasted a year, it was repealed. And you've obviously seen other pushback on tariffs in the US economy as well. And as well, just for disclosure, we don't have any investment relationship with the company, Cleveland Cliffs, that is. So I don't know if you guys have any comments or anything.
Yeah, I'd just say it is interesting, just, what we're going to see, the regional differences in the pricing, but from Canada versus the US. And yeah, it's definitely something that we'll monitor. But, even when we were, looking at this segment beforehand, Brett was asking, is there, a pure Canadian steel index? And, I'm not sure of one. But, it'd be great to actually see that.
Yeah, we do get some lagging price, but no futures or anything, and I didn't think there was any as well. But yeah, no, Ryan, sorry.
No, I mean, it will be interesting to see the price differences between Canada and the U.S. These companies are historically, almost hysterically too, but volatile in their pricing and in the share prices in the sector. You can have, boom bust demand cycles. 1 year a company is extremely profitable. The next year it can literally lose money. They're very difficult to value on a cash flow basis. Like, you have to do a normalized type cash flow. You have to look historically and then look at where their production is coming online. I mean, it is a segment that we'd like to see a really good balance sheet in these businesses because of the volatility. And often there's tons of CapEx. So you have balance sheets that don't look the greatest, but in good and bad times, these companies are very hard to be a long-term investor in unless you're comfortable with the fluctuations in cash flow on a quarterly, year-over-year basis, and are you looking long-term and predicting the business. I mean, like a smaller company that gets built out to get bought in that sector, if it's done well, potentially can be a story. And I mean, Stelco did that essentially over time and was fairly well run, but there's such a high degree of volatility. It's hard to fit our model. All right, let's move on to Brennan. He's going to revisit PyroGenesis Canada Inc., symbol PYR in the TSX. I think you've done this one or two times at least in the past. Very passionate shareholder base that we're commenting many times on this. Every time that we've reviewed it, I mean, we interviewed management in the past, and we think they're competent, and there is potential here. But again, the potential had been contract-driven business, and it really hasn't pushed forward in terms of the sales cycle that they had originally projected. And it just, the share price has been decimated, and we warned on that. You're speculating. We are more, in terms of our investing, we are looking for companies that already have financials that trade at lower prices than when we originally looked at PyroGenesis, and have the potential to have these blue sky upside events in the business. And, it's hard to find those businesses, but if you want to profit long-term, that's what you should be looking for versus speculating on a company that may deliver some blue sky potential. And PyroGenesis, not saying it's a poor company, it's just a business that still had to when we looked at it in the past, it really had to it got ahead of its skis. It really had to backfill a lot of the order book to get to the point where we'd see it had any value at those points. Now we'll see where it is at 50 cents, right?
Yeah,
because this company was significantly higher the last several times we looked at it.
Yeah, and I'll go over like kind of the price and where it was at when we covered it, because we've covered it several times on the pod. So again, PyroGenesis Canada Inc., PYR on the TSX, currently trading at a price of 53 cents and about $100 million market cap. So they design, develop, manufacture, and commercialize plasma processes and systems in Canada. It offers its Drossrite, a process for enhancing metal recovery in the aluminum and zinc industries. Its PureVap, a process to produce high purity metallurgical and solar grade silicon from quartz, and PureVap Nano Silicon Reactor, which is designed to transform silicon for use in lithium-ion batteries. They've also got their plasma torches for replacing fossil fuel burners, which are more efficient from my understanding, as well as plasma arc waste destruction systems for waste destruction. And the company also provides engineering and manufacturing expertise. So, like Ryan said, we've covered PyroGenesis on the podcast back in September of 2021 when it was at a price of about $5.33, in October 2022 and June of 2023 when it was at a price of slightly above $1, and about 1 year ago in July of 2024 when the stock traded in the 70-cent range. And again, today the stock is trading at about 53 cents per share, but was as low as 43 cents over the past few months. So the stock keeps trending lower, essentially, given its weak fundamentals. And every time I essentially concluded that the company had potential, but to us, the business just had yet to validate its business model as it continued to lack profitability, cash flow, or even adjusted EBITDA, and struggled to maintain any sort of revenue growth. So let's look at those financials to see where the company is at today compared to when I covered them a year ago. Well, for the last quarter, Q1 of 2025, revenue was down 14% to about $3 million. Net loss was $4.3 million, or a loss of 2 cents per share, compared to a loss of $4.4 million or 2 cents per share in Q1 of 2024. The company still isn't able to produce positive adjusted EBITDA, losing $3 million in Q1 of 2025 compared to a loss of $3.2 million last year. And cash flow from operations was also a loss of $2 million compared to a loss of $2.8 million for the same period last year. So the company continues to burn through cash. And looking at the balance sheet, its cash balance is now $224,000 with debt and leases of $9.2 million, providing a net debt position of approximately $8.9 million. So given the business is burning cash, how has it been keeping the lights on? Well, as you can see up on the screen here, the company had a net cash position of $23 million in Q1 of 2021, which was certainly intriguing to us. But over the years, the company has moved into a net debt position. So the company has been draining its cash balance, has been taking on more debt, and has been issuing more shares, now up to 190 million common shares outstanding, which it added about 11 million shares since I covered the stock last year. And as I've been saying every single time, which has come to be true, given the dwindling cash balance, debt on the balance sheet, and lack of profitability, the company will need to issue shares once again to keep the lights on. Now, looking at the company's backlog as at May of 2025, it was 52 million, which is expected to be recognized over a maximum of 3 years. And this is up from just 28.1 million in May of 2024, but down from its all-time high of 54.4 million in Q3 of 2024. So it's obviously good to see the backlog is increasing. But, do I think that this, 52 million is now an immediate inflection point for the business? No, but, this backlog growth is certainly something to continue to monitor. And again, because the lack of net income or just any profitability, we have to value the stock off of its revenue, which right now it trades with a price to sales multiple of about 6.7 times, which is down from about a year ago of 10 times, of course, led by a declining share price. Now, last time I covered the stock, I also referenced a few YouTube comments that stated, by avoiding the stock while it continues to burn cash, we will have missed the major initial run, and that we should analyze the company's qualitative factors more in depth. But in hindsight, the fundamentals are what have mattered. And people who got in at $1 or, God forbid, at higher prices took on the risk, which, again, we're trying to mitigate. This is the risk we're trying to mitigate. So To conclude, at this point, the risk continues to outweigh the potential reward for an investment, in our opinion, and we would continue to classify the stock as speculative, given it continues to lose money, now has a net debt position, and will need to service its debt while it remains cash flow negative, and will likely continue diluting shareholders to keep the lights on. The recent backlog growth is positive and something to keep an eye on. And if the company can increase scale and move toward profitability, we would be more interested. But for now, we continue to monitor. And I'm just going to leave you with a quote, which I've heard Ryan saying lately, which I believe comes from Warren Buffett or Charlie Munger. So don't give Ryan credit for it. But I believe it sums up a stock like this quite well. As we could look at the qualitative factors of a company until we are blue in the face, or look at the technology, but fundamentals are like gravity, and the fundamentals are what have been pulling this stock's price downward.
I'm getting I'm getting the feeling that maybe Brennan he just doesn't understand the technology.
I think so too.
Has anybody mentioned that maybe on YouTube in the comments?
I think we've seen it somewhere. Yeah, we've seen that. Definitely, we hear that many times. Many times.
Yeah, I mean, people say, well, you got to look at the qualitative factors. Of course, we look at the qualitative factors. They're incredibly important. But I don't care about the qualitative factors when the fundamentals and the financials of the business are completely horrid, right? Yeah. And I'm not pointing at any individual company here, but like if you have no revenue and no anything in the business to demonstrate that you have a marketable product or service, then then what credibility does the management have when they're talking about the qualitatives, right? Anyways.
Yeah. And Brennan got into the capital raises too, the constant equity raises. I mean, 10 years ago, 85 million, today 183, 184 million. When you continue to, on an annual basis, this company, even on an operating basis, they don't produce income. So you have to go into debt, or you have to then issue equities to fund the business, to fund just the regular course of the business and any growth. And it dilutes existing shareholders. And, they've done that significantly over time. Again, the backlog increase is something that, attracts our attention to the business, but you have to execute on that profitably at some stage. And again, we always, and I always have to say this, is we're looking at a universe of thousands of companies. So there's this company, because it does have some revenue, ranks ahead of probably 90% of those in the Canadian market. But we're looking for the top tier of like 1 or 2% of those companies that have revenues, trade at reasonable prices, have good balance sheets, don't dilute nearly as much as we're seeing here, and have blue sky potential. And though that is, there's many other factors that go into it, but those are some of the fundamental factors that we're looking for in a business. If you don't have those, we can move on to another company, even if, there can be a case that this is a great technology. And if they get the sales in one of the 4 or 5 areas that they're targeting, and it will do well if that happens. But it's a big if. You can find companies that already are and have an if there. You're going to do well if the company just operates its existing business well. There's a growth factor in those businesses that we like as well. And that is the type of business we're looking for, because we're not just looking for upside. We're looking to try to limit the downside, because you can go broke looking for upside in businesses that don't have any fundamentals under them. And this company has some of the fundamentals, but not the level of profitability that we look at. And I sound like a broken record on this. Everybody who's investing in PyroGenesis isn't investing for a 12% annual market return. They're looking for blue sky potential. If you are looking for those companies that do 10x or 1,000%, the data shows you that 90% of them start as profitable businesses. They're small, like this company, but they start profitable. So let's see some profitability, and then you're going to be at least playing in the bucket that gives you a chance to find those 10x blue sky companies that you're looking for.
Yeah, one thing that I'd like to add too is, like, I think over the trailing 12 months, the stock lost like 5.7 million in net income. So, to generate, 6 cents, per share in earnings, the company would have to flip from, losing, 5.7 million roughly, trailing to, all of a sudden getting into, profit of like 12 million in net income. Well, over the trailing 12 months, the stock has done, or the company has done, revenue of like 15.2 million. So, to get them to a reasonable valuation on earnings, they've got a lot of work to do.
Yeah. I mean, right now the stock, even after sinking incredibly from when we first looked at it, after we got questions from clients and people who watch the show, it's on a fundamental basis, it still looks expensive. So we have to put it in perspective. Now it's priced on blue sky. It's priced on the forward potential here, but just be very aware that you need this company to backfill in terms of cash flow at some point. The valuations that are there now. All right, I think that's beat this dead horse here. It's not, again, we're not saying PyroGenesis is the worst company out there. It ranks well ahead because it has revenue of many companies we look at. We're just looking for the top tier.
I actually think that is what Brennan said.
Okay,
well, for the YouTube comments.
Yeah, I'm gonna get some hate mail.
We appreciate all the good comments and the hate comments. We love to debate on those, so keep them coming.
No, absolutely. It's great to have a different opinion. And we'll present our perspective, and you present yours. Yeah.
And a lot of it there is general, not even specific to PyroGenesis. That's what we're saying. Just the profile of the business that we are looking at that gives us the best chance of blue sky upside and the least chance of a massive downside in those businesses. And you still can't prevent that, but we're trying to. Now let's finally close off with the birthday boy, Mr. Aaron Dunn. He's going to provide a synopsis of small cap gold stock, his playbook, 7 timeless rules for picking winners in this segment.
This segment is based on an article that I wrote. I think we sent it out about a week ago, just on what types of evaluation metrics and things you should look at when you're evaluating a gold investment like a gold stock. And of course, this is very, very topical because gold itself has been a huge performer in the market in 2025, given everything that's been going on. So the title of the article was the Small Cap Gold Stock Playbook, 7 Timeless Rules for Picking Winners. And that's what we're going to go through today. So just taking a look at recent performance of gold, the price of gold right now, over 3,300 per ounce. So it's up about 26% year to date, 43% over the past 12 months. And gold miners have actually performed a little bit better than the price of gold. So if I look, for example, at the VanEck Gold Mining ETF, it's up 51% over the last 12 months. Now, this is not typical. I mean, we don't check in on this all the time to see how the commodity gold and gold miners perform relative to each other. But we have compared the commodity price to some of the large diversified producers of gold like Barrick, and determined that really miners are not the greatest proxy to the price of gold because they underperform. But that is always obviously going to be on a case-by-case basis. And particularly when you're dealing with small cap companies, you have the potential for some very explosive growth and also opportunities to purchase assets at more attractive valuations sometimes. So why is gold performing so well? Well, gold is kind of seen as like a hedge against global instability, weakness in the US dollar. There are obviously the trade tensions, geopolitical instability that we've been seeing, inflation concerns. All these are coalescing essentially to make gold look attractive to many investors as an alternative to, conventional financial assets and currencies. So not all that glitters is gold. And, why does a systematic approach matter? When you're investing in a company, you can have all of the bullish sentiment in the world, but ultimately the company is going to succeed or fail based on what that company does, the fundamentals of the business, as we would call them. So this is the balance sheet, the specifics of their minds, all of this. So it's important to be able to understand at least some of the main points if you're going to invest in individual stocks, just so you can even ask the right questions. Now, small cap miners carry even higher risks because they're generally less diversified than larger miners, in some cases only having one mine, and in many cases in areas where the geopolitical risk is high. So many companies can outperform based on their own fundamentals, whereas some companies can actually underperform and completely fail, even in a period of favorable gold prices, because they don't have a strong business essentially to take advantage of that opportunity. So that's why a systematic approach is impossible. How do you separate the quality companies from the higher risk companies or more speculative businesses? And that's what the 7-rule framework is about. Now, I'm going to give the full disclaimer. I am by no means an expert in the mining industry, but this is what I've come up with based on the research that we've done. Okay, so rule 1, follow the cost curve. What does this mean? It essentially looks at a company from the perspective of what are the costs to produce the gold. So the all-in sustaining cost is or AISC is generally the metrics that is used to measure what the expenses are, the total costs, including sustaining expenditures, per ounce of gold, essentially mined and sold. So if you look at the industry average right now, it's hovering around 1,500 per ounce. That is rising, and we would expect it to rise as just from general inflation, but also as the gold price goes up, more capital comes into the industry, exploration, production expansion, and that pushes prices up in the industry. So it generates additional inflation in the industry. So why does this matter? Well, low-cost producers are in an incredibly strong situation relative to high-cost producers. One, they make more money even when the gold price is strong, but they're also far better positioned to survive gold markets. So looking at the costs, comparing them side by side is important just to understand where a particular company compares with its peers. But also what's important is understanding how the costs are increasing. So as I said, we would expect some inflation. We would expect the cost to increase over time. But by how much? So some companies will be better at managing those higher costs than others. And it's important to know if you're looking at a company where the costs are accelerating at a far greater rate than the industry norm, that's something to inquire about. And if it's a company where the costs are increasing but at a lower rate than peers, then that's something that's positive. But you will still want to inquire as to why they're able to do that. Rule number 2: grade and geometry beat hype. So what does this mean? This means, really ultimately, when a company is mining a deposits come in all shapes and sizes, quality levels. And it's important to know what it is what is you're mining. I mean, going way back, remember there's a company that we had coverage on. And again, I'm not an expert when it comes to the geology of resource deposits or mining at all, really. But we have seen examples where companies have been able to mine out of a certain mine where it happened to be high grade and a good geometry in terms of being able to extract the minerals profitably. And then they'll purchase another mine, and you would think that a lot of people would think, well, they have that track record, but often the new mine has a completely different geology or resource deposit. So it's important to know, because in many cases it can completely change the expectation in terms of how they're able to extract that gold or the other resource profitably. So there's different metrics that you can look at. Really, this is something that if you're going to be a resource investor, you kind of just have to have a general sense of what the different types of deposits are, what is good, what is bad. And a lot of that's going to come from talking to management. You can just ask management about their deposits and how they compare and what some of the specific risks or benefits of their particular type of deposit provide. Rule number 3, geography and risk connection. So this really comes down to where are those mining assets located. Political stability is incredibly important, because you can have the greatest mine in the world, but if a civil war breaks out right beside it, or there's no law and order, and you're constantly having to deal with bandits, or if you have to fear government expropriation, things can change very quickly. So knowing which countries are mining friendly, which countries are not mining friendly, where the assets are located in the company that you're investing in, these are very important. Now, several Canadian provinces rank very highly, and Brennan will be happy to know that Saskatchewan is one of those. Whereas there are many African nations that are in the bottom 10 in terms of just political risk. Now, one of the things that I notice when I look at a list of small cap gold producers is that there are quite a few that have incredibly attractive profiles from a profitability and valuation perspective, but they're located in some of the most precarious regions in the world from a risk perspective, geographic risk perspective. So that has to be considered as well. Now, again, we have recommended companies that do operate in regions which are higher risk, but we just made sure that that risk was understood, and also that that was factored into the price that we were paying. We were paying such a good price that we were okay with accepting that level of risk, essentially. Number 4, balance sheet foundation. So this is really any company. It's not just gold. It's not just small cap. It's any company. The balance sheet is really the foundation of the business. This is the debt and the assets. The most liquid of those assets being cash. So you want to make sure that a company is not too overly leveraged with debt. If it is, you're building a business on a very shaky foundation, and any type of problem, that business can collapse. So when you're dealing with companies with debt, there are certain metrics you look at, like net debt to EBITDA, current ratio. But what we notice is that a lot of the companies in the small cap space have what we call net cash, or they're cash rich companies. So lots of cash and little to no debt. Ideally, these are the types of companies we like to invest in. So it's a high percentage actually of the small cap universe are net cash. But also a fairly high percentage have negative working capital, which essentially means that they don't have enough cash and short-term assets on hand to necessarily pay their short-term liabilities over the next year. They may fund the difference with internal cash flow. They may have to resort to debt financing, but generally you want to have positive working capital. So looking at the balance sheet. Rule number 5, management alignment matters. So important, particularly with small caps. I mean, you could have the greatest assets on the planet in the greatest industry with the greatest opportunities. But if you have a poor management team, they can definitely destroy that opportunity. So there are many ways of evaluating a management team. And believe me, that's a segment unto itself that would barely scratch the surface. But one of the things we do like, particularly in small caps, is we like companies where management and board own a meaningful percentage of the shares, therefore being aligned more with shareholders. Ideally, they own those shares due to purchases in the market and not just from stock options. But if a company owns about 5% or even 2 to 3% of a company, especially if they were buying in the market, that's a good sign. That's a good sign that they have optimism in the business. They're aligned with shareholders. And it also, I think, affects their decisions, because we see management teams that aren't aligned with shareholders often make very poor decisions, or poor from the perspective of providing value to the shareholders, not necessarily poor from the perspective of providing value to themselves. So as much as possible, we want to align management with shareholders. One of the ways is what is called skin in the game, or by them, management owning a significant portion of the company. Rule number 6, seek growth catalysts. So what does this mean, a growth catalyst? Well, this is just some event which you see happening, or a high probability of happening at some point in the future, that will result in a increase in, well, the share price, but likely an increase in production, or an increase in cash flow that will drive an increase in the share price. So in the context of small cap mining stocks, what would that be? Well, that could be a new mine coming online. There are companies out there that are planning new mines. That could be companies that do acquisitions. Maybe they have announced one. Maybe they're looking for acquisitions and they have a lot of net cash. So you think that there's a high probability that they will. Could be, in this case, exploration results, which could lead to longer mine life or greater production at an existing mine. But some type of story that is, or well, not a story, but some type of a growth strategy that is understandable, whereby you're seeing production, revenue, and cash flow grow over time. Now, of course, the commodity price can get in the way, but this is what the company can control, are these growth catalysts. How do you find them? Talk to management, look in the presentations, look in the different documents and the news releases. If they have good growth catalysts in place, I'm sure they're talking about them a lot. And then finally, valuation discipline. So this is really, in many ways, where investing goes from being more of a science to an art. valuation is really, what are you paying for that stock? Not the share price, but what are you paying relative to the underlying earnings or assets? So the simplest valuation metrics one could look at would be a price to earnings ratio, price to cash flow, or price to free cash flow. You could even do an enterprise value or price to ounces in the ground resources, or a price to net asset value. But essentially we generally prefer cash flow and earnings valuation metrics for our type of analysis. And really, valuation is not about buying the cheapest stocks. That's not what value investing is. Oftentimes the companies with the lowest valuations are more speculative, and that's why they are selling for cheaper. In the example here, there are a lot of companies that we found in the gold space where the fundamentals are strong, the valuations are low or relatively low, but they're in very dangerous jurisdictions politically, and that's the reason why. So it's if you see a company where it looks like an opportunity from a valuation perspective, you always have to ask why. But essentially, really, valuation is just about not paying any infinite price. So trying to find companies that, they're not too expensive. They might not be the cheapest, but they're good, solid businesses with growth drivers in place. And that's how you handle the valuation. So you put this framework together, and essentially that is what you use to evaluate companies before making that investment decision. And this could even be done in a checklist. You can create your own checklist with these rules. You can add different rules. And every time you go through a company, you can just basically fill out each one of these things: cost, resource quality, geographic risk, financial strength, management quality, growth drivers, or valuation. And if you don't have the answers, well, then that's something you need to go, you need to go out and get. But this is one way that we believe that you can approach investing in small cap gold companies in a way that will potentially maximize that opportunity, potentially, while also managing your risk.
Yeah, good job. Like and even like this last Friday, Ryan ended up bringing, like in our analyst meeting, Ryan ended up bringing, a cash-rich producer. It is maybe a little bit more geopolitical risky. We were looking into their estimated, mine life. It might not be that long, but like this is exactly, what we're talking about is, Aaron saying like, what's a good price to pay? Going through these steps and checking it off and figuring out what's a good price to pay. Like this company, it's all in sustaining cost is about like $900 per ounce, where, like Aaron was saying, industry average, is about 1,500, something like that. Like this company that we're looking at, again, cash rich, I think they had about 20 million on the balance sheet in cash. In 2024, they recovered about 78,000 ounces of gold. Looking forward to fiscal year 2025, they're looking at, about 15% growth in their gold recovered. So, these are the things is, we're looking at it. And really kind of, trying to figure out, is, the risk worth the reward, or is the reward worth the risk? What's a good price to pay? Is it trading at a reasonable valuation?
Yeah, and we can run it through those 7 criteria, and that's what we're doing on a weekly, daily basis, just looking as many companies as we can, comparing them, and trying to find the good businesses. Right now, and if you do look at a lot of the junior mid-tier gold producers, you have to be cognizant of the fact that this is the best environment they've seen in terms of gold pricing basically ever, and the spread they're making is quite high right now. Perhaps gold stays at these prices and even moves higher, but typically gold has had fluctuations in terms of where it is in price. So I wouldn't just be using like the cash flow in the last 2 quarters and annualizing that going forward into a discounted cash flow model and saying this company is worth this. You've got to factor in the volatility in the price of gold. So there's some gold companies that look extremely cheap right now. If the price of gold suddenly comes down, they're all in sustaining costs, or 1,500, it goes down to 2,000. I'm not saying that's going to happen. It can happen, but now you're making 500 where you might have been making 1,200. So it's a significant difference in terms of the spread there. So that has to be factored in for sure. Yeah. Okay, I think that is going to end off our show for this week. Good show. Again, if you're watching this, anything else, guys? Are we good?
Go Oilers, go.
Yeah, Jesus, that is crap. I shouldn't have asked that. All right, so if you're keep your questions coming into our Your Stock, Our Take segments. We'll endeavor to answer those on a weekly basis. If you're viewing us right now on YouTube, remember to smash that subscribe button. If you're listening to this wherever you consume your podcast, rate and review us. And as always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.